Since listing on the New York Stock Exchange back in 1994, Realty Income has paid 670 consecutive monthly dividends. Over that time, the company has increased its payout for 31 straight years, earning its status as an S&P 500 dividend aristocrat. This diagram shows the scale of the firm as of May 2026. With over 932 million shares outstanding, it commands a market capitalization of approximately $59 billion. The REIT model carries a strict legal constraint. The company must distribute at least 90% of its taxable income to shareholders, yet management aims to deploy $8 billion this year for new acquisitions. Surviving as a dividend aristocrat in a high-interest rate environment relies on a structural shift. Realty Income is moving away from a total reliance on public markets, shifting towards a massive, multi-billion-dollar private capital strategy. This footprint provides the baseline cash flow. The company manages over 15,500 properties across all 50 U.S. states, the UK, and 8 European countries. This chart breaks down those holdings by sector. While retail accounts for 79% of the portfolio, the industrial segment has grown to represent 15.4%. The remaining 3.1% is allocated to alternative assets, including an $800 million preferred equity investment in the Bellagio in Las Vegas, generating yield outside the traditional retail sector. This shows the defensive anchor of their European expansion, necessity-based retail. Everyday brands like Sainsbury's provide predictable rental streams regardless of consumer discretionary trends. Management expects this portfolio to expand further, guiding for $8 billion in new investment volume throughout 2026. International expansion is a primary driver of that volume, specifically through a $200 million commitment to build industrial logistics properties in Mexico. Operating at 98.9% occupancy with a weighted average lease term of 8.8 years, this diversification creates a defensive revenue stream. Beyond the physical properties, the capital structure on the balance sheet dictates how effectively those assets can scale. This visualization of the December 2025 consolidated balance sheet shows $58.35 billion in total assets against $29.66 billion in total liabilities. One line item often draws attention, an $11.88 billion deficit in retained earnings. This deficit is a GAAP accounting requirement. Because real estate is depreciated over time, non-cash depreciation and amortization expenses often exceed GAAP net income, even when the company is cash flow positive. The actual leverage metrics remain conservative. Net debt to annualized pro forma adjusted EBITDA sits at 5.4 times, consistent with historical targets. Entering 2026, the firm reported $4.5 billion in liquidity. This position was supported by an $862.5 million convertible note and an $800 million senior unsecured note offering. Maintaining this structure protects an A- credit rating, ensuring the company can continue to borrow at favorable rates for future growth. Because 90% of income must go to shareholders, internal cash flow alone cannot fund $8 billion in acquisitions. Historically, Realty Income solved this by frequently issuing new shares through its at-the-market equity program to fund its purchases. By early 2026, high interest rates made public equity expensive, forcing a search for a more efficient way to raise billions. This chart displays the 2026 Private Capital Initiative, a pivot toward partnering with global investment firms to raise capital without diluting public shareholders. In March 2026, the company partnered with Apollo Global Management. Apollo invested $1 billion for a 49. This deal includes a call option structure. Realty Income can redeem Apollo's interest between years 7 and 15, effectively capping Apollo's internal rate of return at 6.875%. A parallel partnership with Singapore's Sovereign Wealth Fund, GIC, established a $1.5 billion development platform focused on build-to-suit logistics in the U.S. Rating agencies like S&P Global granted permanent equity treatment to these contributions, allowing the firm to deleverage while maintaining its investment-grade credit rating. By recapitalizing stabilized assets through these joint ventures, management can fund its $8 billion pipeline while bypassing unfavorable public stock valuations. This matrix benchmarks Realty Income's strategy against the broader real estate market in 2026. Competitor Agree Realty, or ADC, operates at a lower 3.2 times net debt to EBITDA, but they achieve this through aggressive forward public equity sales. Simon Property Group takes a different approach, choosing to allocate capital toward the redevelopment of its own open-air retail centers, rather than external net lease acquisitions. This shows the operating environment of international peers like British Land, which carries a structurally higher leverage ratio of 7.2 times net debt to EBITDA. British Land operates with a 39.1% loan-to-value ratio across its £5.8 billion net asset base, reflecting a different global risk profile. Realty Income's hybrid public-private capital model is an outlier in the sector, prioritizing the predictability of cash flows over pure leverage. Every joint venture and balance sheet metric ultimately serves one goal: the shareholder payout. This chart tracks the annual dividend, currently $3.25 per share, translating to a 5.05% yield with a 3.51% 10-year growth rate. For Q1 2026, the firm set a monthly payout of 27 cents per share, with an April 30th ex-dividend date. This leads to a common concern for generalist investors: the seemingly alarming 275% GAAP payout ratio. That ratio is a reflection of accounting depreciation. When looking at actual cash flow, the 2026 AFFO guidance of $4.38 to $4.42 per share easily covers the annual dividend. Macroeconomic risks remain, including sustained high interest rates and $100 per barrel oil impacting tenant margins. Despite these pressures, the execution of the Apollo and GIC partnerships has strengthened the financial architecture beneath the company. Management has stabilized the foundations of the dividend aristocrat for the foreseeable future.